name is Andrew Romans. I guess we just introduced ourselves, but I'll do it briefly for those that are catching this on video. First, for the lawyers, this is not, no one is in any solicitation to raise any capital here, so this is purely just an educational, exploring what is venture capital and how it works, and have a discussion around that. Quick background on myself, I've been on different sides of the table. So I've been an entrepreneur my whole life with startups through high school, actually, and college. And then when I was something like 25, I founded a company in the fiber optic cable space that started trading fiber optic cable capacity on an exchange. So without any investors, I was making a lot of money. And then we pivoted into getting our own telecom switches, which were very expensive. And so then we responded to all the VCs that wanted to invest, and we raised $25 million from Lucent. So we're tied to a big corporate, and then we ended up raising about $100 million in total of capital going into an IPO, which fell apart when the dot-com thing melted down. And so I ended up finishing an MBA and then at Georgetown on scholarship, and then I spent about 8 or 9 years advising startups on raising money. And these were typically the VCs would hire me to help raise money for their startups that were struggling, I would say. Now, these companies weren't struggling as much, but a guy who was on the board of Facebook didn't bring me in to raise money for Facebook. He brought me in to raise money for an Israeli company. And part of that process is that you do it for 7, 8 years. I met a lot of VCs raising money for my own company, and then I met a lot of VCs raising money for other companies, and I was seeing more deals than a typical entrepreneur would see. And so there's a bit of learnings that came out of all these transactions, which is kind of interesting. I then founded the Founders Club, which is a bit exotic. It's an equity exchange fund for VC-backed CEOs. So we were talking about SoFi. So what was interesting about the Founders Club is that almost every VC-backed CEO wants to meet you, and they'll give you the story. I also looked at the cap table and the financings of so many companies that there's some wisdom that comes out of just seeing the numbers, of the real numbers on everybody. So when we were talking about SoFi, about their funding plans, I was thinking, well, that doesn't look like reality. Like, reality looks like this. And I'm only saying that because I've seen so many numbers. But those guys had the resources and backgrounds and the hedge fund thing that you're talking about to pull that off, not to mention the good luck of meeting you to invest so much money in their company. So the Founders Club by the way, had 42 VCs on the advisory board, so it became this huge deal flow sharing machine where VCs just wanted access to later stage deal flow, and this was a great way of doing that. I then decided to do something more traditional and just raise a classic 2 and 20 VC fund. So that's Rubicon Venture Capital. That's what I do today. We'll talk a little bit about that later, and we can talk about that offline. But we're a very active VC. We invest at Rubicon in about 1 new startup per month. Roughly, that's our investment pace. We don't have to. Sometimes it's more or less. And we do a lot of follow-on investing. We primarily invest in later stage seed, which is what I would say, that's what Series A used to be. And then we invest in Series A and Series B, where most of the fund goes. And we allow our LP investors to co-invest with the fund. Almost every time the fund makes an investment, it's not always possible. And even when we get to Series C and into these later stage, our LPs can invest through an SPV, a special purpose vehicle, where we aggregate them together. So we're theoretically invest all the way to the end. But the fund deploys most of its money into A and B. Yes, that's enough about me. I also wrote a book that's been translated into Chinese and Russian. It's being translated into Japanese right now. I don't know if you know DA Consortium, DAC. They're like a multi-billion-dollar, if you want to dollarize their yen revenues, they're like an ad mob DoubleClick. They put a lot of ads that you would see on the internet, fixed and mobile. And Michi-san over there is translating my book into Japanese, which is cool. So the book is, I wrote the book, but I brought together stories from about 50 different VCs and a bunch of entrepreneurs and some lawyers, where they tell a story with a lesson learned. So I basically made the outline, and then I asked my own network of VCs to fill it in with them telling stories, and we kind of go back and editing it and then package it together. For the Japanese version, very smart, we're adding a chapter for just Japanese stories. So we're going to have Japanese stories from here in the Valley, from the local VCs here that you probably know, and then in Japan as well. So we're going to localize the content a bit, which I think is smart. Hi, hey, please join us. And and we talked with Murphy. My next book is on the topic of corporate venture capital, which I think is a fascinating topic. I think it's important to get that muscle in at some point. And I believe that the corporates shouldn't just be investing in growth. They should be investing in, if you look at certain companies from Asia doing a lot of copycat, of like just copying one company, why not copy all of it, or get access to all that information. So I think venture capital is a good tool for that. And it's a good two-way bridge. So a quick overview of what we're going to attempt to cover here today. You guys this is a small enough group that you can shout out and give me feedback of other topics you'd like to cover that are not here. But to kind of give a holistic view of the market, I thought first talk about what are the stages. In some ways, these names are meaningless to talk about stage, but particularly if you're investing other people's money, or if you're investing off the balance sheet of a company, or if you're seeking to understand where you fit in raising capital from others, it's not a bad idea to give an understanding. So it's basically, I view it as pre-seed, seed, what does seed cover these days, later stage seed or seed extension, Series A, Series B, Series C, D in that later pre-IPO phenomenon territory and what's happening there, and understanding a little bit of what the dynamics are and the changes that have happened in recent years into a historical perspective, and which parts are a bit crowded or not crowded, and understanding where, different strategies of how to play across these sectors. A little bit about why I believe investing now is more attractive than ever. There's some changes that just did not exist in the past that exist now. And then get into some of the mechanics. And you guys can, as a group, have a mutiny and say, Andrew, not so much detail on the convertible note, please, or more detail on the convertible note. So I think it's worthwhile, like when you're raising money or if you're investing money, I see sometimes someone clearly does not understand what a certain important feature means. And that's a little bit of a problem for the rest of us to deal with the uneducated person. And the more educated you sound, the easier it is to raise money. Whether you're raising money for your fund or whether you're raising money for your startup. So I'm going to force feed a little bit of that to you guys. I'm also going to cover a few of the key points on an equity priced round. So there's convertible debt, the convertible notes, and the price round. These are basically the two ways that the financings happen. And then we'll talk about what some of these terms really mean, like if they're worth fighting for and what they mean on a valuation perspective. And then I'll talk a little bit about portfolio construction strategies. And I'd be interested to get some of your feedback on how you guys are set up. You see a fund make 4 investments and then pitch me on investing in their next fund. I think it's crazy to have invested in 4 deals, but there's different strategies out there. A little bit about deal flow and how to source deals, and a little bit about tactics for getting into deals that are already oversubscribed. A little bit about what different strategies and basic kind of rule of thumb concepts tend to exist out there for follow-on investing. And then a little bit about best practices for post-investment, the importance of things like information rights, and governance, and access to information. And then lastly, a little bit around options for liquidity. M&A and IPO is quite obvious. The secondary market has evolved quite a bit. Even like the time delay for me writing that book, chapter 10 was the ladder to liquidity, where I'm like evangelist about how it's not so bad for a founder to sell some shares before the exit, and it's not so bad for your early investors to sell a little bit of shares before the exit, where I think these days there's not a lot of protest. But amazingly, still like on the East Coast, where we have an office in New York, people are banging their fist and getting red in the face about it's bad for people to get liquidity before the final exit of the company. So I'll talk a little bit about that. It's a strategy for you to get money out anyway. So I think it's worth considering. I'm going backwards. Okay, so let's dive into it. So a quick view on what are the different stages of the financing process. I think that most investors would stay away from the actual love money, the friends, family, and I threw in credit cards. I did a lot with credit cards for my first startup. I had 90,000 in credit cards at the time that I raised my first angel round as a founder. and I was almost making money. Like I would have alarms going off in my Excel spreadsheet of when to pay off this credit card and get like a free airplane ticket I could use to go to Europe for my business. And I almost felt like I was making money by spending money on the credit cards. But like, credit cards is a great way to get money quickly, especially if you probably have a good background if you're founding a company. I think that's an important one that people don't really talk about. I just got back from 2 weeks in London, where I used to live for 10 years, and it's amazing how they finally copied the French, who copied the Israelis on giving these tax incentives. And for people who live in some of these countries, if you've got a lot of taxable income and you invest 100,000 pounds or 100,000 euros or shekels, whatever, from Israel, you're only at risk of losing 25,000. So there's like a ton of things getting funded that absolutely do not deserve to be funded over there. But if you live in one of those countries, you should definitely wise up on SEIS, or Enterprise Investment Scheme, and these tax incentives. Pre-seed. So in my view of the market, let me see if I talk about those same things, but I give some feedback about what I think that stage is. So pre-seed, that means you're investing before the demo day, and you're investing like a machine, like either a very active angel, or you've actually got other people's money that you're investing in a fund, or you've got a seed program investing as a corporate off the balance sheet. And I think that pre-seed is interesting. I think that if you're ready to make a move, there's not a lot of due diligence to do because these companies have barely existed for very long, that you can make a high frequency of investments and get into a pace of a couple a week. You're going to, it's before demo day, so you'd probably want to be a mentor at Y Combinator, and you're roaming the halls and getting in before the demo day. If you're doing a lot of those, you're probably getting in at decent valuations and can make some good cash-on-cash multiples. Things to consider, that a lot of angels or seed funds have to live through it to learn, and I'd encourage you to learn this without spending 5 years of your life, is that don't expect anything to sell very fast. You're that much further away from the exit. If the time delay between Series A and IPO is like 9 to 11 years or 12 years, the time delay to M&A is maybe 6, 7 years. That's probably shortening now with where we are in the economic cycle. If we hit a downturn, it might elongate further. That you might not have any exits before you could talk about raising a fund too. Stephen, you were saying that you've made like 40 plus investments, and in a year from now, you'll be bragging about some of those companies.
Of the investments that we've made, mainly falls between pre-seed and demo day seed, and some in the later stage seed where we've been invited to get on the ground, and to date, many got follow-on funding. So I'm thinking about the B and C's coming out.
So I think that one thing is I think a good VC will raise a new fund every 2 to 3 years. And part of that is you're providing diversification by vintage for your investors, and you're protecting yourself from never becoming a zombie. A zombie is a VC who all the money they have is reserved for follow-on investments into the existing portfolio. So other VCs, angels, and entrepreneurs will not be sending you deal flow if they know there's zero chance of getting money out of you for a new opportunity, when all your money is reserved for the existing portfolio companies. So you want to be raising a new fund every 2 or 3 years. If your story is that you've deployed a lot of capital and there's not a lot of positive news, then it should be theoretically very difficult to raise that next fund. If you're investing a lot of pre-seed, you may be able to say, well, my unrealized gain is pretty good. Of the companies I've invested in, many have gone on to raise money at higher valuations. And so if you can get a sense that you see a milestone in direct line of sight, you're investing at like a $3 million pre-money valuation, or even less. And then they go to demo day kind of stage. You get them into Y Combinator or 500 startups, and then they're raising at 5 to 10 million. You could say our unrealized gain is that we're up. And in the evolving world of secondaries, you might even be liquidating something along the way. So I put secondaries all along the whole as a continuum, that there's often always someone willing to buy you out, which was not the case a couple years ago. A couple years ago, they were too concerned about sending a negative signal. If Andrew is selling and he's been with the company from the beginning, then he must know something we don't know. What's wrong with it, right? Whereas now it's like, no, Andrew wants to buy a pool or something. It's a real world, and the real world costs money. So maybe I just need some money. Okay, demo day seed, this I think is, I don't want to discourage people from investing in it, but I don't think I have to worry about that. This has become so crowded, I think this is the most irrational spot of the market to be playing in right now. I think that, I try not to miss a YC demo day, Y Combinator demo day, and like, they're encouraging you to sit there with the app open and actually commit to invest. And they have a thing called handshake or like. I click the like button, which means I want more information. The handshake means I have no idea what the valuation is, but I'm in. Uncapped note, sign me up. Throw me naked on a highway. I mean, it's just crazy, crazy, crazy. So I think that the demo day seed has, we're overlooking Highway 92 right here, so I'm inspired. But, here in this office where we're standing in. But I think that the number of like restaurant and Hollywood film investors that are not the kind of investors I consider to be the insider, former Silicon Graphics, HP guys in the Silicon Valley that are investing in this space is huge. So there's been a big increase in the number of people that want to invest in this. The phenomenon of being able to attend a demo day, turn this thing off before it rings, the ability to attend a demo day is open to everybody. AngelList has kind of democratized this. So I think that what used to be it used to be an exclusive boys club to be able to access these seed deals is now totally open. As an entrepreneur, I love that, and I think it's great. As a VC, I love it because let other people pay for the experiments, and we can come in with a value-added machine and then really do well. So now I'm still active here. I'm still active in that myself, but I just caution that this part of the market's gone a bit crazy. Later stage seed is less easy to access, but still somewhat easy to access. A lot of these guys are still paying attention to AngelList. You might have met them in demo day and got their business card and you're harassing them to invest in them. So a lot of the restaurant investors are still operational in the later stage seed, but for the very good ones, they're starting to get more institutional participation. They're getting more choosy about what value do you bring to me other than the dollars. So to be able to successfully invest in the later stage seed, you need a story as an investor. You need to describe what value you bring to the syndicate of investors beyond the dollars. And so that makes it harder to get into. If you're just some crazy super active guy, you're talking like, oh, well, I invested in Groupon and LinkedIn and Pandora and you've got a huge pedigree because you sprayed and prayed and maybe they pay attention to that. But today's entrepreneur is probably going to ask you more questions. Can I speak to the CEO of LinkedIn and ask him, how useful you were? The other thing about later stage seed is that, in my opinion, this is a good concept to grip to. In 2001, the economic downturn, I had a front row seat in that. And I had a front row seat in the 2007, 2008 economic downturn. Sequoia slides of September 2008 followed the August 2007 credit crunch. And what happened was the big pools of money that put money into the venture capital asset class watched their stock market value portfolios go down by nearly 50%. And then they figured out, holy shit, our real estate investments are actually down? Is that possible? And then that they're not liquid. And so that all of a sudden, PE and VC look pretty good, and VC always outperforms PE, private equity. So they then said, can we up our allocations into venture capital? And when you call a VC who's getting a 2% annual management fee of the whole fund and 20% of the profit, hey, can I triple the size of your fund? Their first thought is, I can't wait to go home and tell my wife about this. This is great. And their second thought is, well, can I do that, though? I mean, if I'm good with a $50 million fund, will I be equally good or even better with a $500 million fund? Long story short, they grew the funds. So the size of the funds in reaction to 01 and 08, with a little bit of time delay, resulted in anyone whose fund was not performing well got cut off. They couldn't raise more money because their performance was bad. They became zombies, and then the zombies eventually died. Then the existing funds that were performing well they went from $50 to $250 million funds to $500 to $1.2 billion funds. And so when you have the same number of partners and you hire a bunch more young people, and only a few more senior people to deploy the capital, they didn't expand the team to correspond with the increase of the fund size. So the result is that they need to write bigger checks. a friend of mine at Vantage Point, I used to be in the same building with them in San Bruno. He told me he once brought in a humongous bag of pennies, like literally like this big, and then put a mountain of pennies on it and said to this other partner who was fighting for a seed investment, your investment would represent this many pennies. We've got a bigger problem. We've got to move this mountain. So we have to stop doing those little investments. So like your SoFi seed or $30 million A, whatever you would call that, became more normal. The average Series A in the Valley right now is trending at around 10 million US dollars. And in ancient times of the late 90s and to mid 2000s, Series A's often looked like 2 million, 3 million, 5 million. Kind of classic is 5 million on 10, a third of the company. That was like the world I grew up in. Now you're seeing 10 million on like 40 and 10 million on 20. So later stage seed is, the takeaway is that later stage seed is what Series A used to be. And Series A is what Series B used to be. And so on and so on. By the time you get to Series C and later, things often are getting into like IPO territory. The last thing to talk about, and so I would say that Series A is incredibly difficult to get into. So you need a really good brand, and you need to be pretty institutional to play into a Series A. If the founder's raising a $10 million Series A, and some of them are 20 million, and you show up saying, I want to invest 25K or 50K or 500K, someone doesn't like the fact that the CEO is even taking that meeting. So it becomes very difficult to get your money into an A and into a B. I think the optimal risk-reward inflection point right now is to get into deals that are, it's a smaller set of people, it's harder to get into, an A and B. So I particularly think that A and B can make a lot of money. But if you're the Qatari Sovereign Wealth Fund, pulling oil out of the ground like crazy, this is not going to solve your problems. And that playing into these Uber investments is maybe more suitable for you. So everyone's different. The pre-IPO growth in secondaries, I just wrote a blog post about this over the weekend. In my opinion, when Sarbanes-Oxley happened and a number of economic downturns, the IPO window kind of shut, right? And then it started to creep open, but then it was like costing like $7 or $9 million of administrative fees just to do an IPO, and compliance was worse than compliance used to be with the new bad rules from the SEC with Sarbanes-Oxley. And you even saw people listing on AIM in London and stuff, and LSE, to get away from the bad United States regulators. That's no longer the reason that we're not IPOing. The reason people don't IPO now is that you don't have to. You can raise money from the same guys that invested in IPO, like Fidelity, and a whole bunch of new entrants, and stay private longer, and raise, like Lyft raised a $630 million round with 2 closings, with Carl Icahn in the second closing. Carl Icahn's an IPO guy, where now he's a private equity guy investing in this pre-IPO stuff. And some people get it confused with venture capital. So I think it's a good thing that if a company can raise enough money that achieves the objectives of an IPO, you have liquidity for founders. You've got liquidity for early investors. You got liquidity for some of these later investors. You've got enough capital to expand, and even the currency of your stock can be used for acquisitions, then why bother with that expensive, annoying IPO? The other thing that happens here, which is interesting, is that you can provide, we're going to get into liquidation preferences, but they often can provide, like at a minimum, a 1x liquidation preference for the newest investor. So in that pre-IPO segment, you don't get that in an IPO. When you're just taking a biting into an IPO, everything converts to kind of one class of shares. So there's no parachute. Here, if the Qatari Sovereign Wealth Fund, they invested in Uber at I think it was a $39.5 billion pre. Now I think it's at 50 or 55 billion a few weeks later. But to invest 1.5 billion into Uber at a, let's call it 40 billion pre-money valuation, and they have a 1x liquidation preference, that means that their risk is that when Uber gets liquid on an IPO, the first 1.5 billion goes to them. No one gets anything until they get out first. They probably think that they can't lose money on that. They think that their worst case scenario is they get a 1x. It's exciting to invest in a deal like Uber, where the worst thing that happens is you get your money back 1x. It's a sovereign wealth fund, so there's no management fee to worry about. And it'll probably double, it might triple, but it's not going to 10x. Definitely not going to 10x, or at least definitely not going to 10x. If it does 10x, then Uber's valued at 500 billion, That's more than Google. That's more than Microsoft. Those two companies have monopolies. Uber's seen billions go into copycat clones, so that's never going to be a monopoly. So I think that's unrealistic to make a 10x. And another thing is, what is your cash-on-cash multiple objectives? What are your IRR objectives in the sequence? But anyway, this might have been boring for you, and you might think that you knew it all, but I think it's good to walk around confidently understanding what you think the differences are when people are having these discussions, or even asking you, where do you play? I'm not going to dwell on this too long, but the way the world looks now is different than how it looked 10 years ago. When you see these charts that show how much venture capital money is in the system, it's hard to really know how much is in the system. I would argue that 70% of the money in the venture capital system is really pre-IPO, later stage PE stuff. And that just take 30% of that number of what analysts say is in the venture capital system, and that's what is in the venture capital system. We are actually selling a little bit in those later rounds as VCs, and that's basically replaced the IPO and what I call the private IPO phenomenon. But here's some things that are different, and these numbers are old, so you probably can put another 30% on top of these. 5.6 times more internet users now than in 2000. Women are online now. Like when I raised money in '97 from VCs for my startup, it was Star Trek male geeks that were on the internet. Now women make more consumer purchase decisions than anybody, and those women are all online. Undocumented immigrants like from Mexico have prepaid cash to prepaid calls, so they can buy on Amazon too. Everybody can buy from their mobile phone. The smartphone thing is totally disruptive. The social networking thing is totally disruptive. I remember a rule of thumb to build a real consumer company at scale in the 90s that you'd be going into at one point a $60 million venture capital funding round, and you'd be hiring sales team and spending on marketing. Now, you can just get people that are skilled at the black arts of how to get a woman to tweet that she just bought some organic diapers and win reward points, and that's selling more into Twitter and Facebook and all that. So these social networking platforms, iOS is a platform, the app stores are a platform, YouTube is a platform. This stuff just didn't exist a couple years ago. So when someone says, I'm going to invest in medical devices, I'd say that there's been some renaissance revolutions there, but compared to the internet, there hasn't been. I think that the internet and hardware with smart hardware plays is so much better now compared to what it was in 2000. If you say we've only got 30% of the venture capital money is actually venture capital money, that we're not right-sized. There's definitely not enough money to be doing venture compared to 98, 99. And I would say that the advent of these accelerators, like I heard someone say there's 1,000 accelerators in the Bay Area right now. There's a lot of them. But the number of startups being manufactured right now is significant. Those tax breaks that happen in places like Israel, France, and Germany, and the UK is significant, and they're all coming here. All the good ones are going to be coming to San Francisco or New York. So I think that the opportunity to be in venture is enormous, and the opportunity to be a smart angel getting liquid before the liquidity event of the company is huge. The conditions are here now that just did not exist a number of years ago. What did I skip over there? Okay, we'll circulate these slides. I can put them on SlideShare and make them available. I think everybody knows that things are better now, although a lot of people talk about a bubble. This is from Andreessen Horowitz talking about 1999, there was $71 billion in the venture capital system. Now there's $48 billion. I would argue that give that a haircut by 70%, just because in 1999 you did not have the pre-IPO phenomenon. You had IPO phenomenon, rushing the capital markets for venture funding. You look at PE ratios of the technology side of the S&P 500. It was at 39x before. Now it's at 16. I think that there's room for us to get into a bubble. If you look at the actual, numbers, e-commerce revenues back then were 12 billion. Now it's 304 billion. So this stuff has kind of become real compared to what was happening. Interestingly, 4 years to IPO back then, 11 years to IPO now. Until we hit a correction, and a correction could come at any minute, I think that that's maybe shortening. The number of IPOs is smaller because you don't need them. So on being a VC or being an angel, I think it's important to decide, am I truly agnostic and I'll just chase every rainbow that bounces across my desk, or am I going to have some kind of focus? Most corporates will look at what their core business is or peripheral areas or areas of threat and basically choose these topics to be investing in. They might be more interested in the information than they are in a financial return. For guys like me, it's like, well, what is my heritage as an entrepreneur? There's certain things I'm technical on. There's other things that I'm experienced from having been involved in many startups. So it's a little bit pick your sport. The main topics people talk about in the high growth technology venture capital world are internet and software is probably the biggest opportunity. Some people are purely focused on consumer, some are purely focused on enterprise. Some are keen on hardware or include that in their mix. Clean tech, spectacularly fell out of fashion with Solyndra and a domino effect, or them waking up and realizing these have all the components that we don't like for get rich quick. There's med tech is mostly kind of medical devices, and maybe some healthcare IT is bumped into these funds that have a mandate, and then proper biotech. For Rubicon, we've decided to focus on internet and software, both consumer and enterprise, and we surprised ourselves by putting something like 20% of the fund into hardware deals, which are some of our best investments. So we didn't really plan for that. We didn't think we were really suitable for it, but the world has changed again, and so we've had so much commercial success with hardware that we're kind of that upper half. We stay away from clean tech, med tech, biotech, partly because there's risk of total binary failure. They're almost guaranteed to be capital intensive, and the time horizons to exits are longer. The ability to get liquid on a secondary market, meaning get someone to buy your shares or some of your shares before the definitive liquidity event of the company, are more remote than in these upper ones. Obviously, when you're looking at raising money, or if you're looking at explaining who you are as an investor, you probably want to describe what's your geographical focus. For us, we have an office in San Francisco, an office in New York, so most of our deals have happened there because that's where we're bumping into the most people, and they're good hubs. They attract a lot of talented deals, but we will invest theoretically anywhere, but it's mostly across the U.S., Canada, and places like Stockholm, London, Amsterdam, Berlin, where we've got deep VC networks, where we're a little later stage when we invest far from home. And then stage. Where are you at stage? We already talked about that. So basically stage, geography, sector, these are the main things that you need to decide on. What's your strategy? Okay, this is a little bit of understanding the different elements to compartmentalize. What are the different parts of a VC's job? And so if you're building a team, you probably want to have a balanced team that can be effective at all these different things. And you might, your last name might be Rockefeller, so you don't have to worry about raising the capital, and so some of this might be different for you. But, one is to plan the fund and have unique positioning. So what we've already discussed gives you some context of how to make some decisions in that. Recruiting a team is a big deal. You might be best friends with a general partner at Sequoia and a general partner at Excel. Try to get them to leave and join you. Not so easy. So you almost have to figure, like, who can I get to leave and join me? There's a lot of TV shows with that, the drama, and it's very true. Another big part is sourcing deals. What is your strategy to source deal flow? If you're just going to Y Combinator demo days and you're the guy clicking on handshake, like I'm investing without knowing what's happening, I don't think you deserve to be managing other people's money. So what is your strategy to uniquely source deal flow? How are you doing that? What's your strategy to vet the deals and do due diligence on them? If you're agnostic to sector and you're investing in biotech, how are you qualifying these deals? Or any of them? I say seduce the CEO. I think that getting into a deal is a lot like getting someone to leave a bar and go home with you. You better have a good pitch there, right? Like, you better have something to seduce that entrepreneur and get you in. Especially if your strategy is to invest in the oversubscribed deals where there's fistfights to get your money in. So you need to have some way of presenting yourself as an individual investor or a team or a corporate that says, we can do something. Johan, you can talk about how you run Huawei, and Huawei is making a lot of smartphones in China, and if someone's got a mobile app, that you could natively have that app on everyone's smartphone in China. Sequoia now is going to have to respond to that, and so now you're fist fighting into a deal that's hard to get into. What's your strategy to get yourself into the top winning deals? Completing the investment. A handshake and a hug is one thing. Actually wiring money into a deal is another. I had a call over on Saturday with an entrepreneur. I had a call with my partner coming out of Temple. He's Jewish. And then getting the money in, and we doubled our allocation into that, and we're wiring today. I still don't want to share that deal with anybody else until I know we've gotten our money into it. Completing the investment is a bigger deal than some people actually think. Wiring the money and getting documents countersigned. Collecting information on these startups after you've made an investment is becoming a bigger and bigger challenge. When in ancient times when I was an entrepreneur, I used to joke about wearing knee pads all the time. Like, we got to get the knee pads out and raise more money. Now it's like they're asking us to get on knee pads. It's like crazy. Getting information from these young kid-led entrepreneur teams is not easy. They're like, so exactly what is revenue? So like, don't worry about it. I'm like, no, I'm worried about revenues. What are revenues? Getting information out of them is not easy. And even legally, you may not have information rights. There's a major investor clause that unless you had a certain size check, you may not get information rights. I consider information rights to be pretty important to get. And there's the legal information rights, and there's the emotional information rights, and then there's dealing with the weirdo information rights. As much as people say, oh, Steve Jobs, greatest CEO in America, weirdest CEO in America. Dealing with a guy who doesn't shower, and doesn't wear shoes, and he's kind of a hippie, and trying to get information out of him and say, oh, Steve, I've got information rights, so let's hear it. And he's going to go back into his acid dropping room and then come back a week later. So it's not easy to get the information. I take that a bit seriously. And part of my strategy to get information is to be constantly adding value. So if I'm constantly adding value, I'm actually getting into the movie and finding out what's happening there. Okay, add value to your investment to improve your investment and bring the value up and improve your reputation. So the two sides to adding value is, of course, you want to see buy low, sell high, invest as an investor, but you also want to cultivate a reputation that CEO from London tells all of his friends that you're the coolest investor in the world, and now this is fitting into your deal sourcing strategy and seduction strategy and all the rest of it. So I think adding value is important, and being part of the web of all the other VCs across all those stages. If people know you as a value add, and they even start to know what you're good at, maybe you say like, I can help you with China, I can help you with Japan, and I can help you with some other geographies. And the word gets out, they almost know when to bring you in, like you're a strategic investor. Impact the exit. If all you do is pick up the phone and find the buyer, then you're a pretty good value-added VC in my opinion. Even if you've been quite lazy on your boat floating somewhere between Sardinia and Corsica, and you show up to impact the exit, then you're a pretty good guy, in my opinion. You help sell the company, and that's where we get our money out. Collecting information and reporting is a big deal, so a lot of VCs are very bad at reporting. They're kind of like hunters rather than gatherers. They like to get their spear out, money in, money out. That's when they get excited. They don't really like the details, and reporting is a pain in the ass. That probably pretty much describes me, but my partner's very good at the reporting, and I'm good at getting the information that feeds into the reports. So providing transparency is good, particularly in a world of corporate investors. If your investors are all corporates, they want the information more than they want the financial return. So that's a big, important thing. And we do some of this with events. There's even transparency into the entire ecosystem. Building your brand, VCs are brands. I often say to the entrepreneur, when you're trying to decide which VCs to close your deal with, like you'll be facing this hopefully soon, it's a combination of the reputation of the VC fund. Is it a Sequoia or is it the Boiler Room from Long Island? I never heard of it. So what's the reputation of the fund? Chemistry with the partner and the dedication of the partner and what that partner is really willing to do to move a mountain for you. And then the economics. So to simplify it, it's sort of like reputation of the fund, chemistry, value add with the partner, and then the economics, meaning like, is it a good valuation, bad valuation, good terms, bad terms. And then raise your next fund. If you're raising a fund every 2 or 3 years, you should have someone in the fund who understands how the whole world works, or even have one source of capital somewhere to continue to bring money into your system. Okay, so to dive into convertible notes, how many people here have been involved with a convertible note, either raising money on a convertible note or investing in a convertible note? Okay, so I'll do it as quickly as I can because it's guaranteed to put everybody to sleep. When I first raised money, my lawyers, it was a $50K investment, and my lawyers said, let's just do this on a promissory note. And so the money will come in as debt, and don't even worry about the valuation. It's hard to know what is the valuation here. It's all so new. And when you do a VC round, this debt will convert to equity. And at the time, I didn't know these terms, but that was actually an uncapped note with just a little interest rate on it. These days, convertible notes have become much more the norm of how early stage financings are closed. Part of it is that if you're raising money from a large group of different angel investors, which has become more the norm, people used to say as a rule of thumb, you don't want more than 5 angels because they're all bad to deal with. It's horrible, and what you really want is the VC. Now, people have said, well, that's not true. A lot of these angels do add value, and they are good. And take lots of them in and start raising larger amounts of money. So if there's a lot of people, you don't want them fighting about what are the valuation terms. And so the convertible note kind of came in there. But then they say, I don't want to invest in an uncapped note, and if I add value, I'm going to increase the value of the company, and then my little 50K will convert to a $100 million valuation, as opposed to it wasn't really worth $100 million when I invested. So I'm hurting myself if I add value to the company. So that was a little twisted and perverted. So what we have now is, these are the main things to look at. There's the cap, is basically that I'll invest as debt, so I can just wire you the money and sign a document. It's cheap. It basically doesn't cost anything on the lawyer. And then when you do raise a priced round, where you're selling equity at a specific valuation, pre-money valuation, this will convert either to a discount rate, to a discount of that next pre-money valuation, or at the cap. So if I invest now and we say that the cap is $5 million, and then you close money with a VC at a $10 million valuation where you're selling equity, and my money came in as debt to convert to equity, then it'll convert not at the $10 million valuation that the VCs are buying shares at, but it'll convert at the cap of $5 million. So you know it won't be more than 5. If you invest on a convertible note with a cap of 5, but that next round closes with an early investor who's like Peter Thiel, who says, I'm going to make the world move for you, but I'm investing $2 million on a pre of $4 million, and I want a third of the company. The guy says, well, it was the reputation of the fund and the chemistry with the guy. I'm not worried about the economics. I'll do the deal with Peter Thiel. And so he sells stock at a $4 million pre-money valuation. Now, I would convert not at the cap of 5, but at 4, and the discount rate will kick in. Typically, discount rates are 20%. That's what I see as the most common. I would not advise an entrepreneur to raise money at a discount rate less than 20%, because it starts to make you look greedy and unattractive to the angel. Angels are often irrational. And irrationally, they might say, this person's just too greedy, I don't like it. I don't like the discount rate. Well, if the cap is $5 million and you're really confident that it's going to convert, the next price round will be easily north of $5 million, then stop worrying about the discount rate. And that's worth knowing as an investor. Who cares about the discount rate if the cap is sufficiently lower than what we know we're going to convert to? You know, like the cap will set our price. So from the investor point of view, don't worry about the discount rate if you're confident that the cap will set your price and they'll raise money at a higher valuation. And from the entrepreneur side, the discount rate only comes into effect if you sell shares at a valuation lower than the cap. So the discount rate would get you that 10% cheaper pre-money than what the next investor gets if it's lower than the cap. I've seen 30%, and sometimes you're having a tough time raising funding, and you might want to do everything you can to look attractive, and 30% is normal. Going beyond 30%, I think you look desperate, and you should just keep it at 30 with a lower meaningful cap that you can close at. Interest rate must be in there legally for the IRS. Yeah? Sorry?
What's a typical cap you have observed in the market?
Okay, so the question is, what's a typical cap that I've observed in the market? It relates to stage. So in the later stage C demo day stage, like 500 startups often have a 5 million cap, 5.5 million cap. The Y Combinator companies used to be really bad, but in the last batch they got a good talking to, or they listened to all of our complaints, or they noticed that we stopped investing and they've lowered their caps. So I started to see 3, 4, 5, 7.5 million caps. Usually by the time, I mean, I've even seen, we've invested on convertible notes after a price round. So VCs close a round with some deal at like a $40 million pre-money valuation. And then we show up as Rubicon and say, let us get a little check in there to top up your round. It won't upset the ownership percentages, targets of the VCs. It'll have no material dilution to you. We've just done like a $15 million round on 40 pre. And we'll just throw in a couple $100,000 from our fund on a convertible note with a cap that matches the last pre. So we've even done 40 and 60 million caps to just make the legal documentation go to zero cost and get in on the last round after it closed. That's not normal. Normal stuff is investing on a convertible note with anything below 15 million. But I would say the demo day stuff trends around 5 to 10. Interest rates, if you don't have an interest rate, then it's illegal, and you better call a lawyer and make sure that thing gets legal. Interest rates, I've seen them try to get lower to be like LIBOR plus something is like the minimum to stay legal, but 4 to 8% is kind of what you tend to see, and it's worth paying attention to. So what that means is, let's say that I invest $100,000 in a convertible note, and then a week later, Benchmark, big VC comes in and puts in a ton of money. Now, my 100,000 will convert to debt at either the cap or the discount rate, right? We got that now, plus the, let's say, 6% interest rate, but over a year. So it would almost be nothing. So I basically get $100,000 of shares in that deal. If it took a year for the note to go, like, I invest, and it was a year later that Benchmark comes in, and the interest rate is 6%, then what happens is my $100,000 has a multiplier of 1.06 on it, and now I get $106,000 converts to either the cap or the discount rate. So the interest rate rewards somebody for being in there for a long time, and it almost incentivizes the CEO to stop, messing around and get a priced round done. So when people do notes forever, the young entrepreneur might be a little surprised at how much that interest rate took a bite out of him with dilution, and it gave a bit of a kicker.
So the discount rate is not IRR, it's just fixed.
Yeah. So question on the discount rate. So again, let's say that you've got a startup. I invest $100K, and like 5 years go by, and I had an 8% interest rate. That's 8% compounded. So after 1 year, I got not $100,000 to convert, got 108,000, and then the next year it's 108 with 8% on it, growing. And so I end up with a lot more than 100,000 converting into equity when it takes forever. At the same time, I'm not happy about this thing taking so long to get to a goddamn price round either. And so I'm happy that there's a little fire burning to incentivize you to say, so I've seen it where entrepreneur goes, look, we've done like 7 notes at higher caps, so we keep increasing the valuation and bringing more money in, but it's time to take the heat off this interest rate and just call it a priced round. So sometimes they just raise like $1 million price of new money comes in the priced round, and like 4 million of convertible notes converts. So they call that like a $5 million Series A, when in reality they just wanted to take the heat off of those notes.
But that discount is not compounded.
It is. Yeah.
Discount rate.
The discount rate. Or, sorry, no. Oh, sorry. The interest rate
Only the
compounds,
interest rate, right?
and the discount rate is fixed.
And the interest rate is current payment, or it's just
So I'm not sure I understand, but if you put in 100K, and a year goes by and it was say an 8%
no, like
interest
does
rate.
the company typically make current payment each year? Or
No.
it's just like
All
a
it
fixed
is
rate?
that it increases the number of how much your investment amount will convert to. So instead of it being 100K, it'll be more because of time and that interest rate, compoundedly growing. We're good. So I'm telling you, a lot of people don't really understand this stuff, and they just shout out stuff in the middle of the meeting, and they clearly don't know what they're talking about. Another thing to consider is what I call this a conversion feature. And by the way, you could probably pay a lawyer to change all of this and say there's no compounding on the interest rate or something like that. And frankly, it's annoying when I see this stuff. And I tell people, I like it when I see someone has gone with a lawyer that I know, like one of the lawyers that do lots of deals, just because I know there's nothing weird in there. And I can say to the lawyer, because I've known him for 10 years, you know, hey, John, is there anything weird in this note that I need to pay attention to? I mean, I've read it, but is there anything weird? And he's obligated to tell me. So the conversion feature means, and a lot of people will say, oh, this never happens. But, you know, forget that. It does happen. What happens if I invest as debt and then somebody comes along and buys the company? Right? What if it gets acquired and there never was a priced round? How do I convert then? Well, if you're not careful as the investor, they'll just pay you back the 100K plus the interest rate, and then you've redeemed your note. And that's not cool. You didn't get into this super spicy early stage crazy risk to get your money back with a 6% return, especially if you're paying 2% annually over 10 years, so you're leaking out 15 to 20% of your fund to your LP investors. So I think it's key to get the conversion feature settled. It should be a minimum you get your money back 1x, so you have the same feature of a price round liquidation preference. So you don't want to invest $1 million in a company and then the next day, and buy a third of the company, and the next day the guys sell the company for 500K, and you only get a third of the 500K. To stop them from doing that, you have a senior one-time liquidation preference that upon liquidation, you have you're preferred to get your money back 1x, and then after that, it's pari passu. Everyone gets their percentage ownership of the company. This shouldn't be missing from the convertible note. The convertible note I did in like 96 or 97 probably didn't have that in, and they would have just gotten their money back one time plus the tiny interest rate. So Dave McClure manages to get a 2x on every convertible note investment he does, and he's got enough of a personality to do that. If you're trying to join a large group of investors and you say, I want a 2x liquidation preference on this safe note or this convertible note, it might be hard to get, but I think you should get it. Go ahead.
When you say 1x, after that per pursuit, does it mean like, basically this 1x will be returned, and then I still get my corresponding percentage of the company, the rest of the capital?
Yeah, I mean, some people call this participating preferred, and there's non-participating preferred. But in general, what does happen and what should happen, and what I would advise you as an investor to stick to, is to say, when I invest, it's structured, whether it's convertible note or priced equity round, it's structured such that when the company gets sold, I get my money back 1x, along with any other investors in this financing round, before the common shareholders, the founders, get anything. So now you don't have to worry about them selling the company for less than the cash that's in the bank and screwing you. And if they don't have the confidence that they can sell the company for at least the amount of money going in, that's a red flag that this is not a good company to invest in. So if you're investing $1 million in a company at a pre-money valuation of $5 million, and they don't think that they can exit the company for at least $1 million, then should you be investing $1 million in that company?
So let's say I invest 1 million in 5 million valuation, post-valuation, and they sell the company at 2 million. And then for the rest, after I get my 1 million, do I still get like 20?
Yeah. To keep the math simple, if you buy a third of the company, so you invest $5 million on 10. And I'm using this terminology so you can start, speaking in the way people speak. 5 on 10 means $5 million financing, cash in on a pre-money valuation of 10, right? So that means a 33% of the company has been sold to the new investor. So if you're the entire investor syndicate on that round, then you own a third. The company gets sold for $2 million. The first $1 million goes back to you if it's a 1x liquidation preference, and then you get 33% of the remaining $1 million consideration. Okay?
That's called participating.
Yes. Yeah. And
If I don't get the, if I don't get the rest 1 million, that's called non-participating.
yeah, you have the choice of getting the 1 million and not participate in the later, later bit. I think that when people start to mess around with liquidation preferences and some other standard terms in these financings, then it'll affect the valuation. So let me just take off my blazer here. So let's talk about liquidation preferences, which is on the next slide, but we're talking about it now because it's getting built into the convertible note. So the liquidation preference means that we just went through it all, right? You get your $1 million back, and then you get your third of everything afterwards. And then the founders, if they own 2/3, they're getting 2/3 of everything afterwards now that you've been paid off. And usually, if you invest $1 million, it's not being sold for $2 million. You know, usually you're investing $1 million. If it's one of your big hits, you're getting a 10x or better type of exit on it. So everybody's happy. But if for some reason the founder says, no, this is one class of shares, you invest $1 million and you're buying common shares, which have the same rights and privileges as the founders. And so upon liquidation, it just goes straight to you get 1/3 and we get 2/3. If they're asking for that and you still want to do it, which I generally would walk away from that, but if you still wanted to do it, then the pre-money valuation should come down. So it's basically like a directly connected lever of terms, preferred terms, and pre-money valuation. There's no like, oh yeah, you start taking away information rights and liquidation preferences and all this other stuff, and I'm happy to stay cool with the same valuation. Now another thing is in the pre-IPO phenomenon stuff, where the Qataris are putting in $1.5 billion into Uber, instead of getting a 1x liquidation preference, you might get more structured and say, I'm going to give you a guaranteed return of 20% before I make anything. Now, I think it's dangerous to use words like guaranteed in your emails with FINRA and the SEC out there. But you say, I'm giving you a 1.2 time liquidation preference. So now it means you get your money back, you get made whole, you get your money back, plus 20%, and then it's pari passu, everyone gets their percentage. And by doing that, we've moved the pre-money valuation from 50 to 55 billion. And so when when CNBC is on Squawk Box saying, oh, these guys are crazy, what are they smoking in the Silicon Valley with these valuations? They don't know the details, that it might be a 2x liquidation preference, and now the valuation of Uber just went to 80 billion, So I've seen it get toxic. I think some of you guys heard me when I was on the phone with a friend of mine from Chicago saying that we make $3 million investments at a $3 million pre. So they're taking 50% when they take the first bite in. That's like mafia crazy. When I start seeing the liquidation preferences getting to 3 and 5x, and the founder is talking about how great he's doing, I really saw this up close at the Founders Club, where I was getting the common shares of the founder, and I was like, God, these common shares of the founders, your company has to grow at the rate you're growing. It'll take 6 years before there's any value in paying off. If you've raised $5 million and the liquidation stack is $25 million because you've got a 5x liquidation preference on the $5 million, then the company has to be sold for more than $25 million for you to make a penny. And so now let's look at reality checked multiples of EBITDA or top line sales and your growth, and it's looking bad for you as the founder. And if you're a secondary and you're buying shares from founders, so you're actually investing into hot deals by buying common shares from founders, it's important to pay attention to these, details. Yeah. So the other feature that you will see in most convertible notes is a maturity date. So because it's technically a loan in the eyes of the IRS and the SEC, that loan needs to be repaid at some point. And it's usually one balloon payment either in 12, 18, or 24 months. And I think I've even seen 36 months out there. And Y Combinator came out with a safe note, which I forget what the acronym stands for, but like the word that the acronym says a lot there, that they said, why should we ever have our companies be at risk of the maturity date showing up and some nasty angel investor trying to redeem the note and get his money out? So if a company's raised $4 million on notes and now there's like $1 million due, it starts looking like Greece. Like we have to pay back the damn, investor. And I thought that it was really meant to be equity structured as debt. So they said, let's just remove the whole redemption clause. So there is no maturity note. There is no maturity date in a safe note. So I think we kind of did discuss some of the dynamics.
So when it matures, does the liquidation preference kick in?
So what happens when the maturity date comes up is the investor has a conversation with the CEO and says, okay, Joanna, I put $1 million into your company, and I've fallen out of love with you and the strategy, and if I can just walk away with my shirt on, I'm happy. So I just want to get my $1 million back and never talk to you again, because I think you've been lying to me. At that point, legally, she has to pay you back. But you don't have that conversation if there's no ability for her to pay it back. Someone might try to do some great, Marconi debt equity swap and not be an angel investor, but be a devil investor and say, hey, my lawyers are standing right behind me and you owe me $1 million and I know you don't have it. So here's what's going to happen. I'm going to take over the whole company with a debt equity swap. That's evil stuff. I would never do that. If I did, the word would spread that I'm an evil devil investor and I would stop getting deal flow. Angels and VCs would blacklist me, and it would be the end of my career. So even if I've lost faith in the CEO, I'm saying, win some, lose some. Keep trying. Hopefully you do better in your next company. I've written that off.
Oh, you mean typically it's just been written off, it's not converted?
All right. Well, I was in a deal, and I'm going to avoid using names, but I was in a deal where we invested on a convertible note. Two other VCs from San Francisco also invested on the convertible note. And then the company did a funny kind of IPO. If I say any more, you guys will really figure out which company this was. The other VCs redeemed the note through the funds raised from the IPO and then got their money back. So they got their money back plus the interest rate kicked in. Okay, so the interest rate wasn't just money converting to equity. It now actually paid the interest rate. And they were happy to get out alive. I think I had different access to information, and I stayed in, and I've made a 25x on that thing. So it turned out to be, whenever I see those other VCs, I joke about this.
So
Just
that's
to
when
be
you converted?
So I converted, the other guys redeemed. So that was a case of,
When you convert, that means there's already a price round because they went IPO.
that's right, so I converted in the IPO.
What if there's no price round at the maturity? What happens?
Then there's either attempt to redeem, or you sign a document that changes the maturity date and you get an extension.
Okay.
Make sense?
Okay.
Very few people have talked as much about maturity dates as we have here, but I think it's kind of worth understanding all this. I think it's good to have your eyes open going in and knowing what you're signing up to. So I think that's a pretty good analysis of the dynamics of the convertible note. So here's what you need to know about a price round. Yes, please.
So what other differences are there between the convertible notes that the Y company or safe note versus just kind of what we see normally?
Yeah.
Is it just the maturity date, or
No.
are there other terms that are different on the safe?
Yes. Okay. And I officially would like the safe note to be changed. There's some things in it that are founder friendly, and not investor friendly, that I think should be changed. When I was young, I thought a lot of these terms were like mafia, horrible, vulture capital, bad things when I was an entrepreneur raising the money. But I now have a better understanding of why it makes sense to de-risk everything and make it easier for us to invest at a higher valuation. The biggest thing that is obviously different beyond the absence of a maturity date is the loss of pro rata equity rights. So a pro rata equity right is that the investor has the right to maintain their ownership percentage by having an allocation to invest capital into future financing rounds. So if I invest 100K into a deal and end up owning 5% of the company, and I've got an equity pro rata, okay, a pro rata, that means, and then the company raises money at $1 billion valuation. Like, I can't do the math in my head, but I have like a $50 million allocation to maintain my 5% ownership percentage. I legally can do it, okay? And now they're going to raise money at a $1 billion valuation, and like Yuri Milner wants to throw me under the bus and have me not participate because he wants all my $50 million allocation for himself, I can get on the phone and call some guys in Chicago and say, hey guys, I got a 50 million pro rata to get into Airbnb or something. You go whip up an SPV and then I'll agree on your economics. And then they go and call people in Abu Dhabi or something and get $50 million overnight. And now I'm exercising my pro rata equity right. You know, the safe note has removed the pro rata. And a pillar concept for many VCs, and I was going to talk about this later, but I'll talk about it now, is the sense of optionality. That if you invest in 100 deals that are at the seed level, pre-seed, later stage seed, whatever, and you've got a pro rata equity right legally on every one of them, then you can see which ones are succeeding. And now your main fund comes in and deploys 95% of the dollars into the ones that come out of that option pool, plus maybe you muscled into some other stuff that didn't even come out of your option pool. That's like a logical thing to do, right? When the safe note removes the legal pro rata, and you're dealing with young, arrogant CEOs that are first time around the block, that think they're Steve Jobs or Zuckerberg, you got to lock in on $1 billion deal, and they're ready to throw you under the bus, even though you were the early supporter and helped them so much. So I'm like venting a bit here. You know, I like the pro rata, and I don't like it being absent from the safe note. Unfortunately, if you want to party with these people, you got to kind of play by their rules. And right now, safe notes are becoming increasingly prominent outside of the YC community.
But it's a note, right? I mean, it's before even pricing was put in. Like, where's the Prada come from? Prada only comes from equity.
Well, yeah, you can build we've built pro ratas into our notes. And typically, you can rely on the safe note that your equity will convert to preferred shares, right? And so if your debt converts to preferred shares, it theoretically gets all the rights and privileges of the preferred shareholder. However, and this is the big deal, is that the priced round may say there's a major investor clause, and that only major investors get privileges such as pro rata equity rights, and that you invested only like $500K in a safe, and major investors are defined as investors of $2 million or more dollars. And so now you're under the bus. You know? So people that don't pay attention to these details, that are clicking handshake and I'm going to invest in this company while they're giving the pitch, I hope that's just a drop in the ocean for them, and that's not a meaningful percentage of the capital that they're really investing, because it's stupid. It makes more sense to play lotto. My dad calls that tax on the dumb. You know? So, okay. So to priced rounds. These are equity rounds where the company is selling equity for capital or some other consideration. The key moving parts are the pre-money valuation, and some people call that the pre, or they're saying on, and then there's the size of the financing round. So I'm using the classic ancient times example of what a Series A used to be. I'm raising 5 on 10. And so this means that the pre-money valuation is 10 million. The size of the financing is 5 million. And if you add, with addition, the pre to the size of the financing round, it gives you the post-money valuation. So sometimes we'll say pre, round, and post for abbreviations. And so 10 million plus 5 million equals 15 million. Okay? Now, there's the percentage to the new investors, and there's the dilution to the management and insiders. And what I always have done is, for quick math in my head, I take the size of the round, I double it. 5 million doubled is 10. And so I can be really fast like a Wall Street trader and be like, yeah, we're investing 5 on 10, so that's a third going out. And then what's tended to happen is that in a bullish market where there's a lot of competition to invest in that round, the entrepreneurs are selling a smaller percentage with each financing round, hoping to then hit milestones and raise money at a higher valuation, minimizing their dilution, so they own more of the pizza by the time the exit comes, right? So you start to see that it would be more like 5 on 20, and so they're only selling 15%, in this round. Another thing to grip to, if you're ever getting confused, is to divide the small number by the big number. And I keep an Excel spreadsheet on the desktop of my computer for the last 20 years. That's got it, so I can just be typing it in while I'm on the phone with people. And I think most active investors probably do the same thing. Oh yeah, I mean, another kind of thing, and like, I don't know if I made this up or if this is like everyone talks about it, but I tend to think that when you're making early stage investments, you can expect a certain percentage of them to not pay anything back. A lot of VCs in ancient times would say, we have a $150 million fund. We're real Silicon Valley cowboys that make early investments in early venture capital. We're not looking for EBITDA. We invest in loss-making or even pre-revenue companies. We expect that 50 million, a third of our fund, will be a write-off. We'll invest that, we'll never get it back. Another 50 million, we'll be happy to get it back 1x. And that like fist-fighting kind of redemption, being rough, we'll get our money back hook or crook one way. The other, you'll see the dark side of us then. The other third will do so well that it's got to move the needle of the whole thing up to a 40% IRR. So if your deal just looks like it's going to return a 2x or a 3x, go to Hollywood and get some restaurateur to invest in your deal. We're Silicon Valley. We got to see that each deal can return the whole fund. You hear, like Excel has been saying that for a long time. Every investment we make has to have the ability to return the whole fund. Investing in Uber at a 50 billion, well, it's unlikely that it would be bigger than Microsoft, which is at 400 something. So it's not going to return the whole fund. So that's no longer an Excel investment. They might be doing SPVs on the sidecar with a pro rata for it, but it's not the core fund to be doing that. So we follow that policy at Rubicon that every investment we make out of the fund, later stage seed A and B, has to have rational enough pre-money valuations that I can believe in a 10x. Where I don't believe in a 10x on Uber, but I do believe in a 2x for sure, and I wouldn't be shocked if it gets to 4 or creeps to 6. So 10x for the early stage and 4x for the later stage. When you're investing later stage, the good news there is that if you collapse the time to exit from money in to money out, it'll unlock some IRR on that, and it'll enable you to raise another fund, which is a good thing. And your risk, if you structured it with a one-time liquidation preference like Sunrun, with the Madrone family putting in, with the Walmart guys putting in 75 million on top of 75 of A, B, and C, if they get a one-time liquidation preference and they can believe in 4x potential, which I think they could easily get in Sunrun, that's looking pretty good. You're moving a big chunk of money, your management fees are big, your carry is big, your risk of losing is low, and your investors see dependability on investing in what you're doing. If you're getting less than a 4x and you're charging a 2% management fee, which stacked over 10 or 12 years could stack up to 15 to 20% of the paid-in committed capital, getting a 2x is not so great, in my opinion. And you may even generate some bad news because this is technology where things change. So I kind of say 10x early, 4x later. I think getting anything under a 1x liquidation preference, you should recognize that you're practically buying common shares now. And you should be very sensitive to how big is the liquidation stack that needs to be paid off before I kick in. Right back to what we were talking about. Like, when does the pari passu come in for me if I'm below a 1x liquidation preference? I think that entrepreneurs should structure their deals with confidence to be very comfortable giving the new investor a one-time liquidation preference. When you get a lot above 1x, it starts to cause, put additional stress on the ability of the company to raise money. Like, you might have to get the previous investor to rip up those liquidation toxic preferences in order to make room for a new investor to be comfortable to get in. Another thing is, if in all of these discussions on terms, if the CEO is getting too weird with me, then I start saying, you know what? I just realized that you're an asshole, and I don't even want to be here. And I can actually work with assholes, but mathematically and statistically, whenever I work with assholes, that's when I lose. So, the no asshole rule, starts to show its face. And if people are unreasonable, a big characteristic of making money in today's market or even a bad market is ability to raise money in a boom market and ability to raise money in a down market. And if the guys are being too difficult, it gets annoying. And I find that the further you get from places like Silicon Valley and New York, the more strange things can get. And they have like some 70-year-old finance guy who's got all kinds of weird things happening that are not the normal things you see in convertible notes and priced rounds with the usual law firms. All right, so liquidation preference, I think we've pretty much beaten this dead carcass as much as possible. I think we've talked about all of this. The only thing that's in there is buying founder shares, the second to last point. I got heavily involved in the secondary market where I was buying founder shares in later stage deals. And then I even came under FINRA and the SEC under a broker-dealer where I was brokering the sale of early stage investors like in Sunrun and the founder shares. And so I got deeply involved in how to value these shares with all the terms and how they play in. And one thing that we started doing towards the end was we'd say to the investor, look, if you're nervous investing at this valuation, you get your money back 2x or 1.5x, and after that, we split with the seller 50-50. So the founder sells $5 million of stock to the new buyer, who gets into a deal that was impossible to get into, and the buyer gets his money back like 7.5 times, gets like the first 7.5 million back, and then if it sells for 10, we're actually 50-50 splitting the profit above a certain structured return. And you can then go as weird and crazy as you want into playing with those levers. Like, you get 3x back, and then I get everything back. So I sell some shares. I sell 10% of my position as a founder. I buy a house in Atherton. I invest in a fund. I make some angel investments. And after $3 million, I'm so confident, I even get all the upside after the guy's made a 3x. And he felt safe coming in on common. Common. So there's common shares, or like typically the founder shares, and preferred are the the ones with all these rights and privileges like information rights and liquidation preferences that investors get.
So are you still involved in that process? You said you used to do that?
Only that I have some. I stopped doing it. I woke up one day, and we were talking about this in your office last week, or that Friday, that there was a time when nobody wanted to buy founder shares. The VCs were not even interested in that. They're like, I like the real investment kill, and I only like preferred. I wouldn't want that crappy common. But then, and so we were making money doing these deals. Then a lot of people came into it. A few guys actually raised secondary funds to do direct secondaries, not LP secondaries. And then it got so crowded that the buyer would basically, if I were trying to make the buy, they would auction it off to a whole bunch of other buyers. And you got Russians coming in, you've got hedge funds from New York and Connecticut coming in, where for them it's a drop in the ocean. They just want to buy a unicorn logo for their portfolio and overpay. Basically, and then the existing investors have a right of first refusal. We call that a ROFR, right of first refusal. And so when you want to buy shares from a founder, part of the preferred privileges that the Series A guys have or later is a right of first refusal. So you submit the person saying, I want to buy, $1 million of Mark Zuckerberg shares before the IPO of Facebook. They submit this to the board of directors, and it's in their bylaws that we have 45 days to exercise our right of first refusal and buy those shares from the founder at the same price and terms that Andrew's offering. If they don't exercise their ROFR within 45 days, then legally he can sell the shares to me and he's compliant. It started to be that so many people were willing to throw money at these later stage growth, part of the whole pre-IPO phenomenon thing, that it was the dumbest person that would be successful in buying without getting ROFR'd. Does that make sense? Yeah. So I still have some economics on how things will play out in the future, but I gave up my FINRA certification. I stopped being involved with a broker-dealer, and I'm 100% operating in Rubicon under the exemption of venture capital. So I don't do secondaries. We could maybe make an SPV or do a secondary deal one day, but in the context of not getting ROFR'd and all these crazy people willing to overpay to get into them that don't understand the terms, in my opinion, I stay away from it. Some of these financings involve some liquidity, where it's not really taken out to the world. It's just an inside job where the company raises $20 million round. $1 million of that was to provide liquidity for the CTO who's getting all nervous that we should sell. And his wife wants to sell on the last offer to sell. Let's just give the guy $1 million and calm him down, type stuff. And that just comes out of the round. And we said, let's not make a big open process and let confidential information floating around. So private secondaries are happening with the VCs and the founders. and sometimes making a liquidity pool for employee options. Employees can maybe sell 20% a year of their vested securities. What are the most important elements to pay attention to when investing or have that perspective as the issuer, the startup raising capital? I think it's important that the market, go back to that 1/3 of my deals have to pay for all the losers and the 1Xs. That we need to have like real 10X potential or 4X investing late. And so you want to see a big market. You tend to want to see a product that's product driven. It's not just a services deal that anyone could replicate or copy and hurt your margins. And you want sustainable revenues, sustainable growth, sustainable margins. So I like to see some miracle of technology in there. What's the miracle? Or what's the miracle strategy? I mean, if you look at Huawei, with their ability to make things cheaply historically in China, and they had a machine that proved they could do it, it became a monster that's unstoppable. What's the unique thing about the product and the technology that will deliver that kind of success? And never get seduced into a wonderful technology where you know the CEO is an axe murderer. Now, some people would argue that then I would have missed out on investing in Apple. Or maybe I would have gotten to know Steve Jobs and said, this is awesome, and he is the greatest, and he's super committed. But like, to invest in a company where you know the team is not to your liking, your spider senses should tell you to walk away from that. I think you have to have market, you have to have good product, and you have to have team. And you can pick your own strategy of do I invest pre-revenue or post-revenue or even EBITDA positive. But I like to see kick butt market, great team, and great product. A typical thing is companies investing after. There's a million different like playbook plays, and like one playbook play is to say we like to invest in companies that are going to disrupt the market with a big fat lazy incumbent that's too slow to move, or that makes so much money they don't want to rock the boat, and they don't even care about you taking a bite. And then you take a small percentage out of that huge market rapidly, and then you're making 100x on that. Okay, we already talked about actually almost everything on this. I wanted to get into performance warrants. Sometimes as an investor, warrants are basically like stock options for people that are not employees. So if you issue warrants to an investor or a consultant, they have an option to buy shares in the company at a specific price, and don't think of that as investment capital for you to grow your business. They're really only going to exercise those warrants when the company has been made liquid at like $1 billion valuation. They were able to buy in at a pre-money of $100 million. The other time that warrants get exercised in advance of a liquidity event is the maturity date on the warrants. Some people have a pretty tight, like you've got 2 years to exercise your warrants. So if a banker helps the company raise money at a pre-money of 10 million, and then they had like a 2-year, 5-year, 7-year leg, of time to exercise the warrant, like the stock option, essentially, they might see the company's trading at 100 million. They borrow money from Silicon Valley Bank to even come up with the money to exercise buying their shares at a 10 million, or they had the money. So that's what you see with warrants. When I see entrepreneurs saying, this is the pre-money, here's liquidation stat preference, and here's the warrant coverage, most people don't understand it. And if they don't understand it and you're giving something material away, then probably don't do it. So we're operating in a point in history where there's a lot of uneducated investors. And so if the uneducated investor places a value of 0 on the warrant, then you shouldn't give it away. My first job in '93, I was a technical headhunter for Unix people. And when offering stock options to ethnic Indian software engineers back in '93, they were like, dude, show me the money now. That doesn't put food on the table or buy diapers. Like, basically, you could take those options and shove it. What's the hourly rate or what's the base salary? Now, 4 years after that, like by '97, Indians were like, my friend just moved into a huge house because of those stock options. Show me the stock options. That's the show me the money, Jerry Maguire. So now they all wanted their options. Right now, I think we're dealing in a phase where they don't really get the warrants, so they don't even offer them. You do see it with some corporates. Like Murphy, you were talking about, a corporate investor can actually deliver value. So I think it makes sense maybe for the corporate to start introducing performance warrants and say, look, if I'm in the deal with Rubicon, with Andrew, he shouldn't be pissed off if I successfully get us onto 1 million smartphones and I successfully leverage all of our insurance users to start buying this product. If I if I'm responsible for 90% of the revenue of the company, I should get some kind of bump. So performance warrants could fit into your strategy, as an investor there. Valuations, like I wrote a good blog post on this, which I can direct you to, that really gets into it, but I've seen companies hurt themselves by raising money at a higher valuation than maybe they should have. And don't look at me as a greedy vulture capitalist who's trying to increase his part of the pizza at exit. That's really not it. I just want to make sure it all works, that if you raise money because you're a Y Combinator, and so Y Combinator seems to be correcting this. Because there was so much, they managed to get like 1,000 people in the room to invest in companies, and they're pretty good. Within like a week, if not hours, the round is oversubscribed. And so with demand going up against the finite supply of how much they're willing to sell, the valuation just gets higher and higher and higher. And so the Y Combinator company raises money on a convertible note with a cap of 20. So a valuation of 20 million when it's 3 teenagers with a logo that spent 3 months working together with customers that are all YC companies. Like, it's all gained. And so then they're going to burn through that money, and they're so greedy and worried about dilution that they only gave themselves like a 6 to 9 month runway with the capital they raised on the 20 million. Now they burn through that money and say, all right, now we got to raise more capital, and our revenue didn't only not go up, it stopped. Like, there's now no revenue. Shit happens in the world of early stage. And now they're saying, all right, we want to raise money at a much more sane valuation of 10 million. The existing investor from Hollywood, the restaurant movie guy, is going to go to his wife or spouse and husband and say, we invested at, $10 a share, and now it's only worth $5 a share. So we've lost, $250,000 from our $500,000 investment. That's not really true, but that's what they're thinking as amateurs. And should we invest more and hurt ourselves? All of a sudden, the company's losing momentum. So the point is, you want to raise money at a valuation that even with everything if things don't go swimmingly well, that you'll be able to raise money at least at a flat round, the same valuation, or at an uptick. And ideally, you want to go back to that uneducated person in Hollywood and say, hey, do you remember when you invested in me at 10 million? Well, now we're raising at 15 because we've made all this progress. We've hired more people. We've populated the management team. The product's working. We've got some customers. It's a good story. So all of a sudden you're going from strength to strength, kind of generating good news, even though what you managed to do with burning through the cash was the same. So price for success on how you go up, and make yourself attractive to the sophisticated investor who's got a big funnel. There's this basic concept that the investor has a funnel of seeing thousands of deals, and then only takes meetings and calls with a subset of them, qualifies them, and then only invests in a few that make it through to the bottom of the funnel. If you're alienated the really sophisticated value-add investor, it's going back to that, reputation of the fund, chemistry with a partner and VC, and economics. You want to have economics that help you get through the funnel of a top VC. Yeah. Another thing is understand, I see a lot of guys, even VCs, who quit their job as a general partner. They've got a big chunk of cash, and they say, I want to be free from this annoying culture of Kleiner Perkins and just be free to do whatever I want to do. And I'm rich and enjoy life and stop going to Monday partner meetings. And then they go and make a bunch of investments, and even that guy is surprised 6 years later when he's like, I haven't had any exits. I've had a couple failures, and everything's illiquid. And I'm afraid of selling on the secondary market or something because I really want to hang in for the big exit. It's like, how did this surprise you? So it's like, know this going in. It may be easily 3 to 7 years before you start getting exits. And if you're an angel, when I meet an angel who says, yeah, I've made 7 investments in the last 4 years, I'm very active, your investment pace is not good enough to be able to see money coming back and recycle money and do this full time. You're going to end up begging for your job back at Kleiner Perkins if you don't increase your investment pace or even hunt in a pack and join an angel group. Just on that, so for the angel side, if you're an angel investor, I strongly recommend to play in a team and hunt in a pack. And it's very easy to join an angel group. I would avoid any angel group that charges money to the startup to present to you. That's going to alienate all the good ones. And if 10 or 20% of the returns return 90% of the capital in the asset class, then you've just shot yourself in the foot by charging the entrepreneur to pay money to present. That might be good for the owner of that angel group, but it's not good for you deploying capital. Those guys should change their model and finance their business a different way, those angel groups. I think there's a lot of great angel groups. Here, I'd recommend Sandhill Angels. They're actually an LP in our fund and great guys and a great network. And so you have a lot of people. If you're sourcing, if you see 15, 20 deals a week, and kind of one of them a week is really good, then your funnel is 52 great deals a year. If you join an angel group with like 100 people in it or 50 great people in it, all of a sudden you're getting total optics into, you see 100% of the deal flow in the market or within the category that you hunt in, life science or IT or whatever it is, and it's just much better. So for angels, I think it's definitely worth clubbing up with smart people, good on deal flow sourcing, good on deal flow vetting, and good on post-investment value add, for sure. I think angel groups in today's environment sometimes struggle to compete with some of these micro VCs or VCs that have a seed program, that the VC irrationally thinks if he goes into the office of Benchmark, he's going to walk out with a check because it's their job to invest and they've got a dedicated pool. Whereas if he walks into Sandhill Angels and walks out, he might not get a check because it's like a big rodeo of people that can, convert. Rationally, he's got a higher probability of raising money from a diverse set of people that can each make up their own decision than from Benchmark. But they think it doesn't matter what the reality is. The functional reality is that the CEO wants the money from the VC. So sometimes the angel group might want to make a fund, move fast, and then let the rest of the angels double down into the deals they like. All right, so portfolio construction. So you should think of, going back to like that guy quitting his job at Kleiner and becoming an angel, you should think, how much capital does my spouse approve for me to play with here? And how much money do I really want to invest over what period of time? Figure that out and decide, so what's my investment pace? What's my check size? And basically be like a VC if you're on your own and decide what you're going to do. If you're a VC, you absolutely have to do this. If you're a corporate VC, you absolutely should do this. And say, how many companies do I want to invest in? It's like, Stephen, I was impressed that, like, how many companies did you invest in over, like, a 3-year period? 40. So what's your, like, monthly investment pace? Right. So 2 to 4 a month. So, I mean, you've figured out what your investment pace. You probably found when it was too much stress on the team or things all come in bursts. You should figure out, don't let your portfolio construction be an accident. Plan it. Plan it and attempt to stick to it and give yourself some time tolerance to make it happen. So, we do about 1 new investment a month. That's our investment pace into new deals. And we're doing more than 1 investment per month into the existing portfolio. It's where we seem to be comfortable at my fund. I think investing in fewer than 15 companies in a relatively short period of time is somewhat dangerous. If you're a buyout guy and you're investing in EBITDA positive companies, and you're going to chainsaw them up and unlock some value, then that's fine. But if you're investing in risky tech, high growth, loss-making companies, I really think that a portfolio of 15 over 5 years is too slow and not enough. I think there's a lot of people trying to emulate the SV Angel Ron Conway model, which is probably dangerous. People that are investing in 8 companies a week, whether they need a shower or not, they're just pumping it out. Seems pretty crazy to me, but if you have a machine like McClure to do pre-seed, that makes sense to me. We could talk about the risk of economic downturns, of how they impact each stage as well. But bottom line, make sure you're doing, at least, 5, 10, 15 over 3 years, probably not enough. Probably not enough. So consider how many companies are in your portfolio construction, how you're able to add value to them and source them, and the rest of that. Also, I think it's worth deciding, don't let it be an accident of what you expect your first size check to be and how you want to throttle money down. For us, we never put more than 10% of the fund into 1 investment. We think that's a good self-imposed rule to stick to, no matter how excited you get. And so for us, if we went all chips in of 10% of the fund into 5 different deals, that would basically be 50% of the fund's capital. You know, we tend to have around 25 different companies in a single fund, and we raise a new fund every kind of 2 to 3 years. And so for us, it's part of that optionality. That's why I like the pro rata. That's why I don't like that safe note thing. Even though there's a low probability of not getting the pro rata, really, but I like to secure the pro rata so that I could drill more money down into the companies that, you know, we basically have legal insider information on what's happening with these companies, going back to information rights and being a big value-added guy. And we want to put more money into the companies that are winners, and you got to hold hands and do favors for the ones you're not seriously funding to make sure that they say good things about you in the marketplace and you have a good reputation. Okay, and I don't know, tell me when we're supposed to take a break, and you know, if I were sitting down, I might be dying for lack of oxygen.
I think you're supposed to take a break now if you want to.
Yeah.
Lunch is in 1 hour.
Yeah, okay, why don't we take a quick break, have some coffee, and network a bit, and we'll pick it up. Hey guys, since it's such a small group, I had, when people arrived, I had everybody introduce themselves. If you missed the introduction part, do you want to just quickly tell us who you are, and then we can all network a bit here? That's great.
That is fantastic, right? So far with that purpose.
Oh, you're enjoying it?
Unbelievable, yes.
Okay, cool. Thank you.